So one of the most commonly asked questions when we're doing estate planning with clients are, do I need a trust? However, when we ask deeper on where they have to hear about this idea and what do they want the trust to do for them, they actually tell us that they have no idea what a trust is. It's just something they hear all the time. Now, it is true, we hear trust all the time in movies or TV shows, right? Trust fund baby, trust fund baby. But just what is a trust? Now, just so happened I also discussed this topic for my own planning with my CPA over the weekend, which I learned a lot from her. So I've added several points in there from her that she educated me on. So hopefully this video can give everyone a better idea of what a trust is and when and how you should be using one. So if you're interested to dive a little bit deeper into the topic of trust, then this video is right for you. Now, without further ado, let's get started. So first, before we talk about trust, let's look at the two biggest common real estate planning tools and what are their pros and cons. Now, I'm not going to go into super detail on these tools. I've talked about that in my previous video over here. So if you want, check out that video. Now, first common tool is a will. So a will, what it is basically a set of instruction on how to distribute your estate at the point of death. So here are the pros and cons of will. Pros is that it is easy to set up. You can probably get a notary to do it, or even some online platform can do it for you right now. And the cost is often inexpensive. It can range anywhere from $100 to $600 depending on how complicated it is. Now the downside, however, there are many. First downside is a will likely have to be probated, which means you have to pay probate fee and a court must supervise distribution of the asset, which can be very timely and expensive. Second of all, there's no privacy. At the point it goes through probate, it is public knowledge. Everyone can see the content of your will, which also makes it a little bit challengeable or can create conflicts if some of your family member or distant relative is not happy on how you're distributing your asset. Now, the third con is that instruction is more likely only to restrict at the time of the death. After the asset is distributed to your family, they have full control, full access over it. They can do whatever they want with it. Now, lastly, like we said, it is challengeable because it is public knowledge. Anyone not happy with it, they feel like they have grounds to challenge you, they can challenge you. While they might not win, they can significantly delay the process of the probate. So that's will. Now, the second most common estate planning tool is actually using a beneficiary. Now, the typical place to see a beneficiary is either life insurances or any registered account like TFSA, RRSP, etc. Non-registered investments only has beneficiary if you buy a segregated fund which is funded through an insurance company. A normal mutual fund will not allow you to set a beneficiary for your non-registered portfolio, which for most people over the lifetime is likely going to be the biggest piece of the portfolio. Now, pros of beneficiary, there are plenty. Number one is having a beneficiary, there's no probate, which means you skip the probate fee. Now, second of all, it can also help you skip the probate process like we talked about. And lastly is privacy. No one will ever know who your beneficiary is, not even your own beneficiary. So if you somehow like your daughter more than your son and you want to give her 60% while your son gets 40%, that's all each beneficiary will know how much they get. They don't know what the other person got. Now for cons, number one is it only exists in registered plan like RSP, TFSA like we talked about, or insurance. For non-registered, you have to get it through insurance companies or a segregated fund. Now another con is that there's no control after payout. Again, it just goes to beneficiary and that's it. They will get to use it however they want. So those are the two most common tools. Next, let's look at how a trust can fit into the picture. A trust, if you imagine, is basically a tool that can do most of the pros we listed between the two tools while avoiding most of the cons. So first, let's talk about the basics of a trust. Now, a lot of people here, when they think about trust, they make the mistake to think about it like a corporation. First of all, a trust is not a corporation. Where a corporation is a separate legal entity, a trust is not that. Now, the best way to think about a trust is to imagine right now you have a box. Everything that you want to pass on to the next generation, you are putting into this box called trust. And once everything is in, you're placing rules around this box on when they can reach inside and take those items out. After all the items are put into the trust, the appointed trustee, which could be you or another person, would continue to manage this box, the asset that's sitting inside. Now, there are two major categories when it comes to trust. The first is testamentary trust, which means trust that established the moment you passed away. And second type is the inter vivos trust, which are trusts that established while you're alive which is also known as family trust. This video, we're going to focus a little bit more on individual trust because this is most common, but generally both categories have the exact same concept. Now, as you can see on CRA website, there are tons of trusts here, but here we'll just be focusing on the most common three, which is alter ego, which is a trust for yourself, spousal trust, which is for the spouse only, and a joint partner trust, which is a trust set up to benefit both you and the spouse. Okay, so next, let's look at the basic of a trust setup and structure. So when it comes to trust, there are going to be three parties. The settlor, which is the person setting it up currently with the asset, which is likely going to be you. The second party is a trustee, which is the person managing the asset after it's been put inside the trust, and also will be the person handling the distribution. And lastly is the beneficiary, which are the people that will benefit from the income or capital of the asset inside the trust. Now, there are beneficiaries where they will immediately receive the income, for example, you and your spouse. There could also be beneficiaries such as your kids or grandkids, which will only get something once you and or your partner passes away. And basically, a trust is established when the settlor, the one with the asset, transfer the assets to the trustee under the trustee's name for the purpose of benefiting the beneficiary. Once this kind of movement is done, a trust has been set up. Now, before you freak out and say, well, does that mean I have to change my asset and transfer it under some random person's name? You don't have to, because like we said before, while it does require three parties, you could be one or all three parties if you like. Or sometimes if you don't want to mention it yourself, you can also hire a professional trust company to act as a co-trustee. So if something happens to you and you're incapacitated, the professional trustee can step in and continue to manage this trust for you. So those are the basics of a trust. Now next, let's talk about why is a trust useful. So here, let's go through some scenarios and illustrate why and when a trust would make sense for different types of family. So first, let's go through a scenario where they're focusing on controlling the asset. Now, let's say you have remarried and you own a portfolio of 5 mil, and you don't really need to tap into this capital. You only need income from it for retirement. You don't have kids from your second marriage, but you got kids from your last marriage. Now, you want to be certain that current spouse is protected and can retire for life, even if you were to pass away first. And what you would like to do is when you and your second spouse have passed away, all of it would pass on to your kids and your grandkids from your first marriage. You're also not very confident in your spouse, kids, or grandkids' ability to handle the money. What you can do in this situation is put all 5 mil into a joint partner trust between you and your second spouse. You could appoint yourself and a professional firm as co-trustee and set you two and all the kids and grandkids as beneficiary. So doing it this way, you will be able to maintain control even if you were to pass away. Only you and your spouse will be entitled for the income and the capital of the 5 mil portfolio inside the trust during you two's lifetime. Now, what you could also do is set conditions on when, what, and how do they get these money. For example, you can say everyone must finish college before they get X amount. When they reach a certain age, they get another amount, etc. This way you can make sure you're not ruining their life or completely removing their motivation to work because now they have so much money overnight. Now, whereas these kind of setup cannot be done through the first two conventional tools. For example, if you were to pass away with all these portfolio, which is joint name with your second spouse, you're going to roll over all the asset directly to your spouse, who she would now have direct control, and she may not be very good with money, or she might remarry, and then if she get divorced, she can potentially lose half of that. Or versus a will, you can also set instruction, but there's really no further control after the first set of instructions. So that's a very simplistic example of if you want to have control over the asset. Now next, we can also look at more complicated situation, which is using a trust when you have a corporation. So the first scenario, we're going to be looking at how to use a trust to do estate freeze potentially, which means capping your corporate value because it is going to rise very quickly in the future. So let's say for this example, you've started a business with basically nothing, so your cost is 0, and now it's worth 1 mil. You know that giving it another 10 years, it should be worth 2 or 3 mil. You're 50 years old right now and in a pretty good financial situation. Investment portfolio alone is enough to retire. Your kids want to take over the business in several years and you would like to pass it to them when you feel like they're ready. Now, if you just hold on to your shares and pass to them when you pass away, your shares could be worth millions by then, and now you trigger all that capital gain on death. However, what you can do is use a trust to freeze your estate at the current value. What you're doing essentially is basically transferring your common share to the trust with yourself as a trustee and kids as a beneficiary. Thus, you're freezing your cap gain at the current 1 mil valuation. Now, the advantage of this is later on, if your kids change their mind or you deem them unfit to run the company, you can undo this by selling the shares to someone else as a trustee. It also provides another additional advantage like sheltering your trust asset from kids' potential creditors. If they owe some money, if they run into some legal trouble, having all the asset in the trust can protect from the kids' creditors. So even if they get sued, they can't access into the trust. However, doing it like this have a potential of triggering your capital gain early, which means there is going to be more taxation consideration, and you should consult a CPA before you move forward. Now, another example for corporation is if you are planning to sell your company in the future, you can actually use trust multi-lifetime capital gain exemption to really reduce your cap gain at the sale of your company. So let's say the same example as before, but now it grew to 10 mil, so it grew way more than you expected. You basically have a 10 mil cap gain right now if you were to sell your shares today. Now, every Canadian in the lifetime, there's something called lifetime capital gain exemption of 890K. It's specifically for when you're selling your private company shares. So basically when you exit from your business. So in this case, you can take that off, but you still basically have a 9.1 mil of cap gain to pay, which is not very ideal. But instead, you could set it up something like this. Your ABC Corp, which is your operating company, the one that you owe right now that's worth 10 mil, will be able to transfer to the trust like before, and then your holding company holds your trust. So the structure looks something like this on the screen. Now, normally, all your earnings would go to ABC, and then it would flow to the trust and then to the holding company, which act as a piggy bank. The holding company does nothing but hold your cash and hold the trust. And you can name all your kids' spouse as a beneficiary of the trust. At the sale of your shares of your company, of ABC Corporation, you sell it for 10 mil, and you can actually make use of each person's lifetime capital gain exemption because they're all part of the trust. So let's say there are 5 people in total, you, your spouse, and 3 kids. That's 890K times 5, 4.45 mil of cap gain you can potentially use to write down your cap gain of 10 mil. So this significantly reduces your tax bill. Now, do keep in mind, if you want to make this work, it has to be a share sale of your company, and you have to fit, other requirement as well to qualify for this cap gain. If you're selling just the asset, so your equipment's inside, that doesn't count. You cannot use this. It has to be a share sale. So those are the 3 very quick example of how and when you maybe want to use a trust. Now let's talk about the overall pros and cons. For pros, there are obviously no probate, so there's privacy and you can skip probate fee, and also all the asset can keep running. You don't have to go through that long process of distributing the asset. And also there's low possibility of challenge because it's hard to prove a living trust to be incompetent at the time of setup. And also, like we said before, there's control before and after you pass away on how to distribute the asset. And lastly, it's creditor proof. It's great to protect against beneficiary with poor financial literacy or some creditor issue that might come up. Now, however, some instance, if the trust is made solely for the purpose of defeating a creditor, so you didn't really need a trust, you're just doing it because you know a creditor is going to come after you and you're just doing this to avoid them touching your asset. These kind of trusts can be defeated as it has happened before in court. So make sure don't do it for the sole purpose of defeating your creditors. Now for the cons, the cost of setting it up and maintenance can be much higher than conventional tools because a trust needs to file its own tax return, which is ongoing costs, and there needs to be bookkeeping, etc. So it could get very pricey. And also, it can also get very complicated, especially when you have corporations, you bring in multiple beneficiaries. There are rules that you have to follow, or else some trust will lose their status and trigger a lot of the taxation problem. So you likely have to bring in an estate lawyer and a CPA, which will also further increase the cost of maintaining this trust. Now on that, there are several notes that you also need to keep in mind when you're thinking about a trust. Number 1 is, like we said before, trust needs to file its own tax every year. Number 2, income earned inside the trust may be taxed at the highest marginal tax rate. So that's something you might want to consider as well. There is also the 21-year deemed disposition rule, which means that every 21 years, if you don't do anything with this trust, it's deemed as as if it has sold everything every 21 years. So you might have to trigger all that cap gain and close down the trust. Now, there are going to be ways where you can roll over and roll forward the trust, but 21 year is something you should keep in mind for your family trust. So with that said, who is likely to benefit from a trust? You can really look at it in several perspectives. Number one is obviously the asset size. If your asset is quite large into the multi-millions and you really worry about people's spending power and financial literacy upon receiving such a large amount, maybe a trust would make sense. Number two is really about the control. Do you really care about that control? Most people don't, even if the asset amount is big. Then if you don't, then you don't need the trust. Now, lastly, I would say is more important is age. What is your current age right now, and and your kid's age? I also wanted to think about a trust originally, but I was discussing with my CPA, and basically she said, you're pretty young, you don't have kids yet. Even if you do, the kids is very young. So if you have a trust right now, you have to spend years of maintaining it, which is all that extra cost, plus the 21-year deemed disposition rule. So age, really, you want to think about it more likely, probably like anywhere from, I would say, 45 to 60 plus. That's when you want to start thinking about trust. So age is definitely another consideration here. And lastly, like we said, if you have additional planning needs, for example, you see yourself selling shares of your company, you want to make use of the lifetime capital gain exemption with your family by setting up a trust, then you might also want to do that as well. So those are all the considerations you should have before establishing a trust. Now, this video is only aimed to give you more of a basic knowledge of when and why you should be thinking about it. Really, if you want to start talking about trust or restructuring your company to add a trust in, you have to talk to a professional CPA and bring in an estate lawyer to do the whole thing together to make sure you're well covered in terms of tax and also the legal perspective. All right, so that's everything I want to share today. It's going to be a quicker video. I want to hear from you. Do you have a trust right now? Are you thinking about setting one up? If you are, what is your structure looking like? Let me know in the comment below. And if you like these kind of videos, I do upload them 8:30 EST, so you make sure to like and subscribe to my channel. Click the bell button to get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!